Coming up on the SBS On the Money podcast, the jobless rate rises slightly, but 32,000 jobs were created. We'll take a closer look at that. The US dollar continuing to weaken, and we take a closer look at the election impacts on the Australian share market. That's next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Thursday, the 17th of April 2025. A good day for the Australian share market in this shortened trading week. Remember, the markets are closed on Friday and on Monday for the Easter break. The S&P ASX 200 up 0.8%. We'll have the details soon with Chris Weston from Pepperstone. But first to the economy, where the Bureau of Statistics says the jobless rate rose slightly to 4.1% in March. That's despite 32,200 jobs created in the month. So for his take on what it means for the economy and for interest rates, I spoke with David Robertson, the Chief Economist at the Bendigo and Adelaide Bank.
Still tight labour markets. The unemployment rate did edge up from 4 to 4.1%, although the underemployment rate is still incredibly low at 5.9. So we've still got labour markets that the RBA are characterising as tight, and another reason to be slightly cautious on the official cash rate. Having said all of that, this is a look in the rear vision mirror. This is conditions for March. We really need to think about what the economy is going to look like as the year progresses. And our forecasts do have a higher unemployment rate ahead. We're expecting the unemployment rate to be above 4.5% by the end of the year. And certainly the global backdrop will be creating different conditions to what we've seen for the last 6 to 12 months. And you'd expect there'll be some hesitancy through businesses around hiring intentions. And let's face it, when the world's two largest economies are in an irreparable trade war, there are going to be consequences for global growth and global demand.
So what do you think it'll mean for the RBA when it comes to meet to discuss interest rates in May? There have been expectations by some in the market, and the money market itself pricing in at least a 50 basis point cut in May. Do you think that's still likely to happen, or given this strong jobs market we're seeing, will it dial down those expectations?
We do still have 25 basis point cuts as our expectation quarterly in May, then in August and in November. And I've even thrown one in for February as well, given recent developments. So that'd take us down to 3.1%. Can't rule anything out in these conditions. May the 20th is still a month away, so who knows how the markets will have performed over that period of time. Certainly, if you saw a deterioration in confidence to the extent that it almost resembled the GFC in terms of confidence and liquidity and credit, then there'd be coordinated central bank action, and you might think about the RBA going 50, but we're nowhere near that at the moment. Equity markets are actually pretty firm through Asia, despite what's happened overnight in the States. So, look, if the RBA were to go more than 25, I'd actually prefer they went 35, and then another 25 in July or August to get us to 3.5, which would even things out rather than this 4.1 that we've got at the moment. But we're not expecting 50 basis points at present. You'd need a deterioration in global conditions for that to be the outcome.
That is David Robertson there from the Bendigo and Adelaide Bank.
Now, Market Day on the SBS On the Money podcast.
Good day for the Australian share market. The S&P ASX 200 up 0.8% to 7,819. For more on the day's market moves, including what the federal election will mean for shares, I spoke with Chris Weston, the head of research at Pepperstone. Chris, the ASX is now up around 6% from its low point 2 weeks ago following Donald Trump's so-called reciprocal tariffs. Is the worst over?
I think the worst in terms of tariffs is over. We're still going through the 90-day pause, and anything's still possible in terms of the idea of things being derailed. I think he has lost some of his leverage. The market or the other leaders from other countries have seen that he's very sensitive to market moves, and that's going to give them a little bit more leverage. Certainly Europe, for example, is going to see the idea that, 2nd and 3rd of April probably had to give him what he wants. They've seen his sensitivity. They've seen his hand under game theory. And perhaps they might try and get a little bit more than they bargained for before. So, yeah, I think we've got to keep our eyes or keep an open mind to the possibility that the 90-day pause isn't as smooth sailing as people anticipate. But I think, what we're seeing today is that Japan are getting on very well. Looks like they're going to form some sort of bilateral trade agreement. Australia seem to be very much in a good place at the moment, both in terms of how they're dealing with Trump, but also, not siding too much with China, but not losing the relationship there. So it feels like the worst is over. But what we're doing now, Ricardo, is we're looking at the aftermath. People moving assets out of the US. We're looking at the data, the fallout from that, and pricing recession risk. So, I think it's too soon to say that, the coast is clear. There's a lot that still can go wrong. We can still get higher volatility as such. But, I think the worst in terms of tariffs probably is over for now.
Speaking of that volatility, when you look at the US market, where a lot of the action has been, right? You mentioned investors looking at what do they do with their assets, or if they pull money out of the US, where does it go? Has all of the volatility that we've seen, has it settled down? We saw a lot of action in the bond market. We saw equities markets as well. A lot of superannuation funds invested in international shares are tilted towards the US. What are you seeing?
Well, I think some of that capital has come out. We've seen big capital flows out of US equities. They were the exceptional story. You're getting higher levels of return on equity across multiple companies in the US. Obviously, that's where you're going for innovation and those companies with strong pricing power and monopolistic qualities. I think people are still looking at the AI scene in the US and saying to themselves, look, we've got this AI diffusion review that takes place on the 15th of May. That's a really big deal. A lot of people want to buy NVIDIA, but they can't do it until we've actually got that out of the way, because that's going to give us a lot of conjecture around the export controls. I think once that takes place, then we go into NVIDIA's earnings, 10 or so days later. And these overhangs from that space, we'll know a lot more. A lot of the news will then be in the price. I think people will start going back in. We could see a nice rally after that, and that will coincide with more clarity around tariffs and some of the data. But I think the world is now saying to themselves that we've got a president in the US who is clearly looking after American interests, and in American interests only. And that means having a more sort of geographically split. So having access to some Chinese companies, European companies, UK companies as well, maybe some emerging markets. It's not just about only going into the US. So I think that story has evolved, and I think people are looking at that geographical diversification a lot more closely now.
What about currencies? I think one of the interesting things that I've seen over the past couple of weeks is that big shift down in the Australian dollar, but it's now back up to where it was 2 weeks ago. So it's recovered all that big fall. Can you run us through what's happening and what's driving the currency? Because a lot of it has to do with the weak US, right?
Yeah, well, I think I came on your show, on your program a week ago when the Aussie dollar was trading around, below 59.30 or so. And that was the point that it was pretty much the low point in the Aussie dollar. Since that point, as you say, it's come back up to test the range highs around 64 cents. But it's a US dollar story. It is a US dollar story. The US dollar has been the weak link across the whole G10 complex and across most major currencies. And the Aussie has benefited from that weak US dollar story, but the Aussie is still down against the Kiwi dollar, against the euro, the pound. So it has been a dollar story there as well. And I think people have been, as it's part of that repatriation trade, so much capital is in the US, as we talked about, decades of people going, we're getting a better performance there. The companies, the innovation is all in the US. We want to be in US treasuries because it's also the deepest liquid market out there. And that a lot of that capital is coming out of the market, and it's being redistributed to Australia, to Japan, China, wherever it's, wherever the domicility is coming from. So I think, we'll see how much of that continues to play out. But I also think, we talk about recession risk around the world now as a result of the impact that this friction at global trade is going to have. I don't think we're really talking about it in Australia, but we are on recession watch in the US, and the betting markets at the moment are saying there's a sort of a 50-50 chance that we get a recession over the next 12 months. So we just don't know, and the data will tell us. So we're going to wait for the PMI numbers, the Purchasing Managers Index, that come out on 23rd of April. That will tell us a little bit more about that. The hard data is coming through, what happens with the labour market, and we'll slowly price in this idea about recession risk, which is what the US dollar is really, really trading on. And that means then the Fed who have been very patient of late, will then probably have to come to the party and start cutting rates, and maybe that comes in June. So yeah, the US dollar is the weak link at the moment, and that's really what Aussie dollar's pushed up to 64 cents. But the Aussie is weak against other currencies, so it just backs up my statement that this is the US dollar story there.
Finally, with so much focus on US tariffs, there's another big event that we haven't really given a lot of attention to, and that's the federal election, right? Are there any tangible impacts on equities?
Yes, there is. I think, the ALP party now are obviously seem to have the momentum. They're favoured now in the betting markets. They've given a sort of an 80% chance. That with policy, so they're fairly similar in terms of the policies. But I think really the move in Aussie equities probably comes on the level of seats. If the ALP party were to win the election, an outright majority of 76 seats or more, I think we'll probably get some relief, because the market wants to see continuation of policy. They're happy with they're happy with the right level of fiscal spending playing through. They're happy with Albo's relationship with Trump and to an extent China. Continuation is good. Let's keep moving on. Where it becomes a problem, though, is their ability to govern. And that means if they were to get less than 70 seats, 70 is probably a line ball call. If they were to get more 70 to 74 seats, then they'd probably get enough independence to come through. That would mean concessions with increased spending, but that would mean you'd probably have some sort of functional government, and new legislation would pass with some tweaks, but it would pass reasonably easily. If it goes below that level, then you're going to get more independence into the party. It becomes very messy to govern. If any signs of the Greens have to play a role in that as well, and I think what you see is a perception of gridlock. Lower fiscal spending, lower government spending, and I think the market would say that's not good for risk. And I think, so I think the seats matter, their ability to govern matters, and I think that's where we'd see some volatility and underperformance from the ASX 200.
That is Chris Weston there from Pepperstone.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.